Most people click on a Palantir video expecting one of two things: either blind hype about the next artificial intelligence moonshot, or the usual warning that the stock is too expensive, too mysterious, and too risky to touch. But what if both of those camps are missing the real story? What if the company many investors still treat like an untouchable black box is quietly turning into one of the most important infrastructure plays in the entire artificial intelligence race? And what if the move most people think they already missed is only the beginning of a much bigger re-rating? If you clicked on this video because you want to know whether Palantir could still be one of the best ways to play the artificial intelligence boom from here, you are exactly where you need to be. In the next few minutes, we're going to break down the financial engine, the strategic alliances, the smart money behavior, the technical setup, and the exact levels that could determine what happens next. And if you enjoy research-driven stock breakdowns with no fluff, tap, like, subscribe, and let's get straight into it. To understand why Palantir has become such a polarizing stock, you have to start with one simple idea. This is not a normal software company, and it is not being judged like one either. What we are looking at right now is a rare convergence, the kind of setup that does not appear often in public markets. On one side, you have elite operating performance. On another, you have new strategic relationships that dramatically expand the company's role in artificial intelligence. Then you add institutional validation, improving sentiment, and a technical recovery that caught a lot of bearish traders completely off guard. That combination is what makes this feel like an N of one setup, something unique enough that the old playbook stops working. So the real question is not whether Palantir looks unusual. The real question is this: how is a company of this size producing numbers and attracting confidence in ways that feel almost mathematically unfair? That is where the first quarter numbers hit like a wake-up call. In the first quarter of 2026, Palantir reported $1,063 million in revenue. On its own, that is impressive. But the deeper story is what sits underneath that number. This marked the 11th consecutive quarter of accelerating growth, which is already the kind of consistency investors dream about. Then you look at the Rule of 40 score, and suddenly the conversation changes entirely. Palantir reached an astonishing 145%. To put that in perspective, the benchmark for a truly elite software company is 40%. Palantir is operating at nearly 4 times that standard. That is not a normal outperformance. That is a statement. Then layer on top of that a fortress balance sheet with roughly $8 billion in cash and no short-term debt hanging over the business, and the usual overvalued argument starts looking thinner than ever. But that still leaves one major question. Where is all this power really coming from? A huge part of the answer is the United States revenue engine. And this is where the story gets especially interesting. For years, the lazy narrative around Palantir was that it depended too much on government work. But now the commercial side is exploding in a way that changes the entire framework. United States commercial revenue surged by 133%, showing that companies are no longer just testing artificial intelligence tools for side projects or innovation theater. They are moving toward embedding Palantir into the guts of their operations, where decisions, workflows, risk systems, and mission-critical processes actually live. This is the AIP effect in full force. At the same time, the government business did not slow down either. United States government revenue still climbed by a powerful 84%, which means the old business is strengthening while the new business is accelerating. And when both engines fire at once, the market starts paying attention. But even numbers this strong were not enough to explain what happened next. Because then came the catalyst that pushed Palantir's identity further into the future: the alliance with NVIDIA. This was not just a flashy headline designed to excite traders for a few sessions. This mattered because it helped clarify what Palantir is becoming inside the artificial intelligence stack. With Nemotron open source models being deployed into sovereign artificial intelligence environments, Palantir is no longer just another software vendor trying to ride a trend. It becomes the orchestration layer, the connective tissue between world-class compute and the highly secure institutions that cannot afford mistakes, leaks, or operational fragility. Think about that for a second. What happens when the most sensitive governments, defense bodies, and critical infrastructure systems want advanced artificial intelligence, but they need it in controlled, trusted, secure environments? Someone has to bridge performance and security. Someone has to turn raw capability into usable power. That position is where Palantir starts looking less like an app and more like essential infrastructure. And that was only one part of the strategic shift. At nearly the same time, Palantir strengthened its footing in defense through the Army's Next Generation Command and Control program, and that matters more than many investors seem to realize. This is not just another line item in a long list of contracts. This is tied to one of the Army's highest priority modernization efforts, which means it carries long-duration significance, not just a temporary revenue pop. Contracts like this are hard to win, even harder to displace, and incredibly valuable because they deepen trust over time. When a company becomes embedded in systems this sensitive, replacement is not simple, and that creates durability. That durability is exactly the kind of thing major institutions love to see. And sure enough, the so-called smart money noticed. In the first quarter alone, Jennison Associates reportedly added more than 10 million shares, while Goldman Sachs and Arrow Street Capital also expanded their positions by millions. Ask yourself this. Do institutions pile in like that because they are chasing a meme or because they see a multi-year platform story beginning to lock into place? Then there is the short seller angle, which may be one of the most psychologically important pieces of the whole puzzle. For a long time, Palantir had a cloud hanging over it because high-profile bears saw the valuation as absurd and the stock as vulnerable. When a famous short seller builds a narrative around a company, it can weigh on sentiment far beyond the actual size of the position. But when reports emerged in late June that Michael Burry had covered roughly half of his short position, that overhang started to break. And this is where market psychology becomes fascinating. When one of the most recognized bears in the world starts backing away, even partially, it sends a message. It tells the market that the easy downside may already be behind us. It invites institutions to get more confident. It pressures remaining shorts. It changes the tone. Could it mean Palantir becomes immune to volatility overnight? Of course not. But does it remove a major mental roadblock for buyers who were waiting on the sidelines? Absolutely. And once that shift in perception begins, Wall Street usually does not stay quiet for long. That is exactly what we saw in the analyst landscape. Price targets began moving higher, and the tone changed from hesitation to grudging respect, then from respect to outright optimism. D.A. Davidson upgraded the stock to a buy with a target around $175, effectively signaling that the business had grown enough to justify what once looked extreme. Wedbush pushed even harder with a target of $230. Bank of America held the street high with a target around $255 per share. If a target like that sounds aggressive, that is because it is. But aggressive does not automatically mean irrational when the business narrative is changing this fast. The bigger takeaway is that the consensus is shifting. This is no longer just a stock that analysts cover with caution and caveats. More of them are starting to treat it like a category leader with real staying power. And to understand why that change happened now, we have to look at the recovery that forced everyone to reconsider. On June 25th, Palantir hit a 52-week low of $106.37. At that moment, a lot of retail investors assumed the thesis had broken. The stock had been sliding, the noise out of Europe was not helping, and risk appetite across the market was still selective. To many people, it looked like confirmation that the valuation had finally collapsed under its own weight. But then the tape flipped. Palantir snapped a 7-day losing streak and rallied 20.5% in just 5 sessions. That is not just a rebound. That is a violent change in character. And what made it even more impressive is that the stock outperformed both the S&P 500 and the NASDAQ during a stretch when plenty of investors were still behaving cautiously. In other words, this was not the market dragging Palantir higher. This was Palantir forcing its way back into leadership. But every explosive recovery creates a new question. How much is too much? Too fast? That is where the technical picture becomes both exciting and tricky. As the stock pushed through the $130 resistance zone, momentum looked undeniably bullish. Buyers clearly regained control, and the price action started signaling that the worst of the recent washout may already be over. But we still have to stay objective. The relative strength index has been hovering around 67, which tells us the stock is getting close to overbought territory in the short term. And whenever that happens, it creates tension between believers and traders. Long-term bulls see confirmation. Short-term traders start anticipating a breather. Both could be right at the same time. A stock can remain strong while still needing to cool off. So the key is not to panic if momentum pauses. The key is to understand whether the pause becomes healthy consolidation or the start of a deeper reversal. And one place to look for clues is the options market. When you study the near-term options chain, you can see where traders are trying to force the next battle. Open interest has been stacking heavily around the 130, 131, and $132 call strikes for the July 10th expiration. That tells us there is still a camp betting on continued upside pressure even after the rebound. At the same time, short interest remains meaningful, with roughly 76,400,000 shares sold short. Relative to the float, that is not an apocalyptic number, but it is still enough to matter if price keeps grinding higher. And here is the subtle twist. The borrow fee is relatively low, around 0.25%, which means it is cheap to stay short mechanically, but emotionally, it gets more expensive every day the stock refuses to roll over. That is how squeezes sometimes happen, not from panic all at once, but from persistent pressure that turns conviction into fatigue. So if momentum continues, what exact levels matter most from here? For the coming week, the big target on the upside is a retest of the previous high near $147.90. But before bulls get too excited about that destination, they need confirmation. One of the most important breakout levels sits around $136.20. A convincing move above that zone would suggest the stock is escaping the declining channel that recently trapped it. On the downside, the first serious support area sits near $112.20. Beneath that, the major psychological floor is $100. Those are not just random lines on a chart. They are emotional zones where narratives harden or break apart. Above roughly $143 to $147, supply could get heavy as traders take profits and skeptics reload. So yes, there is opportunity here, but there is also friction. And that brings us to the biggest objection still holding some investors back, the valuation paradox. If you pull up Palantir on a basic screen and look only at the trailing price to earnings multiple, it looks outrageous. Around 145 times earnings is the kind of number that instantly scares off traditional value investors. And to be fair, if this were a slow, ordinary business, that reaction would make perfect sense. But Palantir is not being valued on stagnant expectations. It is being valued on accelerating growth, expanding strategic relevance, and the possibility that its role in secure artificial intelligence infrastructure becomes far more important over the next several years. That is why growth-adjusted metrics matter here. When you look at the price-to-earnings growth ratio, the number lands much lower, around 0.42 to 0.50. In growth investing, a figure under 1 is often considered attractive, even undervalued relative to future expansion. So the question becomes, is Palantir overpriced? Or are many investors still using old-school measuring tools on a business being built for a very different era? That distinction matters because it shapes strategy. For long-term investors, the cleaner plan may be to accumulate on weakness, especially if price revisits the $112 to $115 zone. That area offers a more attractive entry while still respecting the broader bullish thesis. For shorter-term swing traders, the setup is more tactical. A long entry above $136.20 would signal breakout confirmation, with a possible move toward $147.90 if momentum holds. But discipline matters just as much as conviction. If the stock closes decisively below $112.20, that would weaken the near-term structure and raise the odds that the market needs more time. So this is not about blind optimism. It is about matching the time frame to the setup. And if the company continues executing, the longer runway could be much bigger than most people currently appreciate. Because the real bull case here is not just a bounce, not just an analyst upgrade, and not just a trendy artificial intelligence label. The real bull case is that Palantir is evolving from a speculative narrative stock into a mission-critical infrastructure company for the sovereign artificial intelligence age. That is a very different category. Companies can rise fast on hype, but infrastructure businesses command entirely different levels of durability, pricing power, and strategic importance. When you combine elite fundamentals, a rapidly scaling commercial engine, deep government entrenchment, the NVIDIA relationship, smart money accumulation, and a market that may still be underestimating how defensible this position could become, the picture starts looking much more powerful than the headline valuation suggests. So the path of least resistance may still be higher. The stock may not move in a straight line, and it almost certainly will not move quietly, but the bigger trend could still be in its early innings. Quick disclaimer before we wrap up. This video is for educational and informational purposes only and should not be taken as financial advice. I am not your financial advisor, and every stock, especially a high volatility name like Palantir, carries real risk. Always do your own research, consider your time horizon, and make sure any investment decision fits your personal financial situation and risk tolerance. So here is the bottom line. Palantir is no longer just a controversial stock that people argue about on valuation alone. It is becoming a serious contender for one of the most important artificial intelligence infrastructure stories in the market. If the company keeps delivering on growth, deepening commercial adoption, and strengthening its moat in secure environments, then what looks expensive today may someday look obvious in hindsight. But that is exactly what makes this moment so interesting. Are we looking at the early stages of a long-term compounding winner, or a stock that still needs to prove the market got ahead of itself? Let me know in the comments. Do you think Palantir becomes the dominant operating system for sovereign artificial intelligence, or does valuation eventually become the wall it cannot break through? If you found this breakdown useful, make sure to like the video, subscribe to the channel, and I will see you in the next one.